Ever feel like you're trying to put a puzzle together, especially when it comes to like, well, everything happening in the world right now?
Yeah, totally.
You just want like the important pieces without having to like sort through a whole mountain of information, right?
Absolutely. It can be overwhelming for sure.
Well, today we're doing exactly that, taking a deep dive into all the recent drama we've been seeing with the global stock markets.
And for this deep dive, we've pulled together a whole bunch of reports that have been, tracking all these market moves and trying to figure out like what's driving all of this. Basically, think of it as us doing all the heavy lifting so you don't have to.
Yeah, exactly. We're cutting through all the noise, getting you right to the heart of what's happening, what it might mean for, well, what might happen next and why you should care, all without like boring you with all the complicated financial jargon.
And it really has been a pretty wild week on a global scale, hasn't it?
Definitely seems that way.
Some pretty steep drops in Asia, especially in Tokyo and Taiwan, where the markets fell by over 4%.
Wow, that's a significant drop.
Yeah, and then that unease kind of like rippled out to Europe too, where major markets, like Britain's FTSE 100, the CAC 40 in France, Germany's DAX, they all started the day down and then just kept falling as the day went on.
So from what our sources are saying, what's the common thread here? What's spooking the markets?
Well, it seems to boil down to like a few interconnected worries.
Okay.
The potential for inflation to, keep getting worse. Some signs that the U.S. economy might be slowing down a bit, and then, of course, all these ongoing trade tensions, especially the ones President Trump has been pushing.
Right, and especially, I imagine, with his recent, pretty strong comments about those new tariffs, calling it a liberation day.
Yeah, exactly. That kind of rhetoric definitely doesn't help calm things down.
No.
Because it sort of signals a real commitment to a policy that could potentially really disrupt things, right?
Right. And speaking of disruptions, let's dig into the real-world impacts of all this. So we've seen these widespread declines in stock markets worldwide over the past week. And one sector that seems to be getting hit particularly hard is the automotive industry. What's the connection there?
What's really fascinating, because it shows how directly these trade policies can impact specific industries.
Yeah.
Our sources are pointing out that several, major car manufacturers have seen pretty significant drops in their stock values. We're talking about big names like Toyota, Nissan, Honda over in Asia, and then the European giants, BMW, Mercedes-Benz, Volkswagen. It's not just some abstract market fear. It's hitting these companies where it hurts.
And it's not just international automakers that are feeling the heat, right? U.S. companies are seeing an impact as well.
Oh, absolutely. Tesla, for instance, dropped quite a bit in pre-market trading, something like 4.5%. General Motors and Ford also saw declines, though a bit less drastic, around 1.4% and almost 1% respectively. So yeah, these global trade concerns are definitely having a ripple effect across the board.
So why are automotive stocks specifically taking such a hit? What's the market anticipating?
Well, the main concern is those potential 25% tariffs on imported passenger vehicles and, crucially, on key car parts. The thing is, the automotive industry relies on these super complex and interconnected global supply chains.
Right.
So if these tariffs actually go into effect, it could seriously mess with how these companies, manufacture and distribute their vehicles.
Yeah.
And it's not just about increased cost either. It's also about the potential for cascading failures. What if a key component suddenly becomes unavailable because of these trade barriers?
Right.
That could lead to production halts across multiple manufacturers and even potentially spill over into other related industries as well.
So higher tariffs essentially mean that bringing in parts and finished cars gets way more expensive. How does that then trickle down to the average person who's thinking about buying a car?
Well, in all likelihood, if these tariffs are implemented, consumers are probably going to see those higher prices reflected at the dealership.
Ah, okay.
Manufacturers are probably going to have to pass on at least some of those increased costs to maintain their profit margins. So, yeah, that new car you might have had your eye on could end up being quite a bit more expensive than you initially thought.
Makes sense. Now let's shift gears a bit and talk about something we often hear about when markets get shaky. Safe haven assets.
Okay.
What are those exactly, and what are we seeing happening with them right now?
So basically, when things get all volatile in the market, investors tend to get a little bit skittish. So they start looking for assets that are seen as less risky.
Right.
Things that are more likely to hold their value, even when the rest of the market is going crazy. Gold is like the classic example of a safe haven asset.
Right, yeah.
And, according to our sources, gold prices have actually just hit a record high $3,154 an ounce. That's pretty telling, wouldn't you say?
Yeah, that's a pretty big sign that people are feeling anxious.
Yeah, exactly.
What about the US dollar? Typically, we think of that as a pretty stable currency. What's happening there?
That's actually quite interesting. It seems the US dollar has just experienced its worst monthly loss since 2022.
Oh, wow.
Yeah, which might seem a bit counterintuitive at first, right? Given that the US is kind of the center of this whole trade tension thing.
Right.
But if you zoom out a little and consider the potential negative impacts these trade policies could have on the overall US economy, well, it's possible that the market is signaling some concern about the long-term economic strength of the US.
So a weaker dollar, in this case, could actually be another symptom of these wider economic worries that are kind of stemming from this whole trade situation.
Exactly. It's like a piece of the bigger puzzle.
And this overall sense of uncertainty seems to be reflected in the revised economic forecasts that we're seeing from some of the big financial institutions, right?
Absolutely.
Like Goldman Sachs, for example. What have they adjusted?
Right. So Goldman Sachs has actually lowered its target for the S&P 500. They're now predicting a 5% decline over the next 3 months. That's a pretty significant shift in their outlook, don't you think? It suggests a growing concern about, how the market's going to perform in the near future.
And it's not just a short-term worry either, right? Goldman Sachs has also bumped up their assessment of how likely a U.S. recession is.
Yeah, they've raised the probability of a U.S. recession happening within the next year to 35%. So it's clear that economists are getting increasingly worried about where things are headed.
And another term that's been popping up a lot in these conversations is stagflation.
Oh, yeah.
Can you explain what exactly that means and why it's becoming such a concern?
Stagflation. That's a bit of a scary one. It's basically this nasty economic situation where you've got rising inflation, so, cost of everything's going up. But at the same time, the economy isn't growing. It's stagnant. It's a really tricky situation for governments and central banks to deal with because, well, the usual tools they use to fight inflation, like raising interest rates, they can actually end up slowing economic growth even further, and vice versa.
Right.
The fact that we're even talking about stagflation right now definitely suggests that there's a deeper worry about the possibility of, a prolonged period of weak economic performance coupled with those rising prices.
So it really feels like all these layers of concern are building up. And on top of all that, our sources also point out that corporate scandals can really further erode investor confidence during times like these.
Yeah, and that's where things get really interesting. It's like how these seemingly separate issues can feed off each other. So you've got these big macroeconomic concerns hanging over the market, and then specific problems within companies can act as these additional triggers for investor anxiety. And a really good example of this is the case of big technologies.
Yeah, tell me more about that. A company with a £1 billion valuation now facing an investigation. What happened there?
Well, it seems they're being investigated over some potential undisclosed connections between the founder of the company and certain shareholders who apparently made a lot of money during its initial public offering, back in 2021. And then the recent suspension of their chief executive just added fuel to the fire.
So how has the market reacted to all this news?
Not well. Their share price has taken a nosedive, dropping by a whopping 29% since the CEO was suspended. It just goes to show how important corporate governance and transparency are, especially when the whole market's already feeling shaky. Any hint of wrongdoing or instability within a company can really spook investors when they're already on edge.
Right, it's like a crack appearing when the ground's already unstable. Now, another term that popped up in our research was wealth effect. How does that concept tie into all this market volatility we're seeing?
The wealth effect. It basically describes how people's perception of how much money they have can influence how they spend their money.
Okay.
For a lot of people, a big chunk of their wealth is tied up in assets like stocks or property.
Right.
So when the stock market's doing well and the value of those assets goes up, people tend to feel richer.
Yeah.
Even if they're not actually, seeing more money in their bank account.
I get it. So if someone's watching their investment portfolio grow, they feel more financially secure, maybe a bit more willing to splurge a little.
Precisely. They might finally book that vacation they've been putting off or make a big purchase they wouldn't have considered before.
So what happens when the market takes a dip like it is now?
Well, when those stock values drop, people start to feel less wealthy, even if their actual financial situation hasn't changed drastically.
Right.
This can lead to a decrease in consumer confidence, which basically means people start holding back on spending.
Makes sense.
And since consumer spending is such a huge driver of economic growth, a big pullback in spending can really contribute to an economic slowdown.
And our sources are indicating that we may already be seeing some evidence of this wealth effect playing out in real time, right?
Yeah, some recent economic data has shown a decline in retail sales and a dip in consumer sentiment.
Interesting.
And the timing of all this lines up perfectly with the market downturn we've been discussing, which suggests that there might be a link between the two.
Yeah.
It just goes to show how what happens in the stock market can have real consequences for the broader economy.
So we've covered quite a bit in this deep dive. The global market downturn, the specific challenges the automotive sector is facing due to these potential tariffs, investors moving their money into safe haven assets like gold, the more cautious economic forecasts, the impact of corporate scandals, and of course the role of the wealth effect. If you had to sum it all up, what are the key interconnected takeaways here?
Well, I think what really stands out is how interconnected everything is in the global economy. Markets don't exist in a bubble. Trade policies that are enacted in one part of the world can have a ripple effect across all sorts of industries and economies. Rising inflation creates this atmosphere of uncertainty, which can then get amplified by geopolitical tensions and those growing fears of an economic slowdown.
Right.
And then you've got the behavior and transparency of corporations, which can either boost or completely undermine investor confidence. And finally, you have consumer sentiment, which is like this crucial feedback loop, translating all those anxieties in the financial markets into tangible changes in how people spend their money in the real world. It's all connected.
So for our listeners out there who might be investors trying to navigate these choppy waters, what are some general strategies that our sources mentioned as potentially helpful during times of market turbulence?
Well, diversification is always a good starting point. Spreading your investments across different types of assets can help reduce your overall risk.
Right.
Because if one sector takes a hit, your whole portfolio isn't dragged down with it.
Makes sense.
Another important principle is to focus on the fundamentals. Look at the underlying health and long-term prospects of the companies you invest in, rather than just reacting emotionally to short-term market swings.
Yeah, don't panic sell.
Exactly. Taking a long-term perspective is generally a wiser approach. And, of course, staying informed about economic developments and any relevant policy changes is always a good idea. Knowledge is power, as they say.
And just to be super clear, we're not offering specific financial advice here. Our goal is to help you understand what's influencing the markets, but for personalized guidance, talking to a qualified financial advisor is always the best course of action.
Couldn't agree more. This deep dive is all about giving you context and understanding, not telling you what to do with your money.
So, as we wrap things up, what are the key factors that our sources have highlighted as likely to shape the future direction of the market?
Well, the future of trade policy is definitely a big one. We need to keep a close eye on any further developments regarding those tariffs and how other countries react to them.
Yeah.
Another big one is inflation. Will those inflationary pressures continue? And how will central banks respond?
Right.
Will they adjust interest rates? And then finally, those upcoming corporate earnings reports will give us a better idea of how companies are handling these current economic challenges and what their outlook is for the future.
Lots to keep an eye on. So, as we bring this deep dive to a close, I'd like to leave you with a final thought. Given all these complex, interconnected global economic factors we've discussed today, everything from trade wars and inflation to corporate vulnerabilities and consumer confidence, what single piece of information that we talked about do you think will ultimately have the most significant and lasting impact on the global financial landscape? And maybe even more importantly, why do you think so?
Yeah, that's a great question.
It's worth taking some time to really consider how all these different elements might interact and shape the economic future we're all heading towards.
Absolutely.
Thanks for joining us for this deep dive. We'll see you next time.
See you then.